Every time there's a crisis, whether it's a war, inflation, or a stock market crash, one thing almost always goes up: gold. So gold has been trusted over a number of years, thousands of years, as a store of value. And today, the best way to own gold isn't holding bars or coins under your bed. It's buying gold ETF. In this video, I'm going to explain why I think everyone should own gold, why gold has performed well in the past market disasters, and why gold investments make so much sense for regular investors. This video also builds on what we've been learning so far about ETF investing and portfolio building. Let's start with some history, because history leaves clues for you to be able to make some decisions. During the Great Depression in the 1930s, while stock markets collapsed and employment soared, gold held its value as governments clung to the gold standard. In the 1970s, when inflation in the US hit double digits, gold prices exploded. It climbed from around $35 an ounce in 1971 to over $800 an ounce by 1980. In 2008, when the global financial system almost collapsed, the S&P 500 nearly fell 37%. Meanwhile, gold rose 5% that year. And more recently, in the 2020 pandemic, as markets were panicking, gold surged to all-time highs above $2,000 an ounce. The pattern is clear. Whenever there's fear, gold is where investors run to protect their wealth. Gold in the financial world is pretty much called a safe haven. And this is why, if you want to be on track to be an investor, you want to make sure you are aware of the safe haven that other seasoned investors use as their safe haven. Now, here's the thing. Buying physical gold is expensive and inconvenient. You need to store it securely, insure it, and sell it through dealers if you ever need the cash. Gold ETFs solve that problem. An ETF, or an exchange-traded fund, is basically a stock you can buy on any brokerage account, but is backed by real gold sitting in vaults. What does this mean? 1, you can buy and sell instantly, just like normal shares. 2, transaction costs are way much lower than buying physical gold. 3, you don't need to worry about storage and insurance. So if you're going to use ETFs, you just have a few clicks on the screen like I shared with you before in my other videos. And all of a sudden, you have the exposure to the price changes in gold. So if you've been following my channel, you know that we've been building our investment portfolio using ETFs. We've talked about broad market ETFs, we talked about thematic ETFs, we talked about different types of ETFs and even how you research on it. If you want to find out more information, you can check some of my previous videos. I'm going to link in the description and also in this video up here somewhere. Here's the key. Every portfolio needs a hedge, a way to protect yourself when the stock market is all red. Red means it's all going down. That's when gold ETFs actually come in. Gold actually tends to move quite differently from stocks and bonds, which makes them a powerful diversifier in your portfolio. When equities are falling, gold usually rises, or sometimes it holds its value when other asset classes are falling down. You can think of it as a safety net. You might not think of it when markets are going up, and you might not even think you need it. But it's such a safety net for you when markets are plunging in fear and everybody is selling. You will be happy that you have some gold. So at this point, I don't want to make gold sound like some magic bullet, but I need you to keep some things in mind when you're thinking of gold. Gold does not pay dividends like stocks, and it does not pay rent like property. In strong bull markets, it can underperform other assets, and so it might not look attractive at that time. And it's about stability, not rapid growth. At this point, what most market experts say is to have a percentage of your portfolio in gold, not the biggest percentage if you are looking to gain from the equity market, but a good percentage that can hedge against when markets are turning and the world is operating in fear, most people will move to gold. So that is what a hedge usually does. A hedge gives you the exposure that protects you when the markets are moving down. So to wrap up, gold has survived empires collapsing, recessions, inflation, and currency crisis. For me, that's more than enough reason to own some gold. Not a personal financial advice, obviously, but I personally believe that everyone should hold at least some small allocation of gold in their portfolio as a hedge if they are investing in the stock market. I have some gold and I buy it through the investments platform on Revolut. You can also have the exposure on all platforms that you use to buy ETFs. You can use my previous videos to learn how to select the right ETF to buy, because I can put some ETFs here, but it might not be suitable for your goals. So just go to ChatGPT and work with it to find the right ETF for gold that you need to get the exposure that you're looking for and to work out the percentage of your portfolio that you want to put in gold. But I do think it's important for me to put this out there to look at gold as part of your portfolio when you start on your investment journey. It's been Abigail. Share, like, subscribe, and we'll catch you later.